Today, we're talking about secrets of the wealthy. If you're in the ultra high net worth category, you may be wondering if there are strategies out there that you should be invested in. Because with greater wealth gives you access to better options. And today, Matt and I want to discuss if that's the case. So we thought it'd be kind of fun to share our first time unabridged wealth building secrets of the ultra high net worth that these elites refuse to share with the public. Matt, do you think we should give them our secrets?
I'm excited. I think we should give the people what they want.
There it is. Comprehensive guide to the powerful wealth building secrets the rich elite keep concealed from the general public.
Boom.
It's a lengthy list, Matt.
I don't know if we'll have time to cover it.
Yeah. A little hat tip to honestmath.com. That's where we got the idea from. So shout out to them. But our main point with that is, sure, there are things that when you have a certain level of wealth that you might be able to access, but it doesn't mean that they are necessarily better or that there's something special. I think there's kind of two main categories that people get pitched or drawn into, and that would be private investments and alternative funds.
Yeah, I think private investments, whoever came up with that term was clearly a very good marketer because even just as something as simple as the word private has a unique appeal to it. It sounds exclusive, it sounds cool, and often these types of funds and investments make for great chatter at the country club with your buddies or at a cocktail party with whoever. It's always fun to be able to say you got into something that either they couldn't get into, other people couldn't get into, and there's definitely a unique aspect from a conversational standpoint that these things are attractive. But as we'll get into here, that doesn't always make them the best thing.
Yeah, a little bit of one-upmanship sometimes can be at play when you're kind of running in these circles. And there's two qualifiers in order to even get into these types of funds. They are being an accredited investor and then a qualified purchaser. So an accredited investor is someone that makes between $200,000 or $300,000 per year, depending on if they file single or file jointly, or they have $1 million of investable assets. So assets, basically anything outside of your home equity. So that's kind of the first level. So certain funds, you have to be an accredited investor to get into them. And then the second one is called a qualified purchaser. And for that one, you have to have a minimum of $5 million of investable assets. So it's a little bit higher tier, and that usually gets you access into maybe some more illiquid funds and that sort of thing. But, like with labels, with anything, people like to say that they're in a certain a circle that they run in. They're an accredited investor or they're a qualified purchaser. But we'll talk about does that really even matter?
Yeah, I think the phrase that comes to mind, Stephen, as I was thinking about this topic and different options that are out there, and the kind of restrictions you were just talking about that the SEC currently has in place, the phrase that came to mind was just because you can doesn't mean that you should. And so people that are above those thresholds of income or assets have the opportunity to invest in these things, while people below those thresholds obviously don't from a legal and regulatory standpoint. But just because the high net worth and ultra high net worth people are able to doesn't mean that they should necessarily. And there's a lot that goes into that decision that we'll talk about here in a minute, I'm sure.
Yeah. So let's dive into that. So why do we think that even though you can do something, maybe you shouldn't? So we're going to list off a couple of resources here. So first one is ultra high net worth peer networks themselves. They share what their members are actually invested in. And the first one that we'll reference is Tiger 21, which is a fairly well-known. Again, this is a peer network of ultra high net worth folks. So people that have usually made tens, sometimes hundreds of millions of dollars by selling a business, they want to interact with their peers. And usually there's a way to, share advice, ask for help, that sort of thing. It's kind of hard to do that when, you have an insurance agent or a financial advisor or an attorney just always kind of jumping in there and and trying to sell you stuff. So they've developed these peer networks. What we see here is a breakdown of what Tiger 21's members are actually invested in. So, Matt, is there anything that jumps out to you initially as you kind of look at this pie chart?
Yeah, the things that I think are a little bit different about this chart versus a chart of maybe the typical retiree or the typical high net worth investor is a little bit larger allocation to private equity and private real estate. So that's real estate buildings and funds that are not available on public exchanges. And those are very large portions of the pie chart here, which ultra high net worth people tend to do based on what the founder of Tiger 21 has shared, largely just because of background and comfort, where a lot of people in this group have had business sales or real estate deals that were very successful. And these are people that have always been entrepreneurs or always been real estate investors and owners, and they stick with what they know and they like doing it. So that's part of the reason they have such big allocations to those asset classes. But again, just because these people are doing it and the Tiger 21 people know those asset classes very well and have a lot of experience doesn't mean that every ultra high net worth person should see this and then go out and feel like they need to get some private real estate and get into some private equity funds. That's not our view at all.
Yeah, I think the distinction is these folks are real estate professionals in their own right, either developers or whatever avenue. So they're expert in this. So they just own this already. So it's not like they come into this group and go, oh my gosh, I have a whole bunch of money. I'm going to put some money in real estate. And I'm going to put some money in private equity. That's not what this is saying. And I guess the other thing I'll point out is that there's a big exposure to public equities and how little exposure there actually is to hedge funds and currencies and pretty much anything else. And it looks like a lot of these folks like to keep some money set aside in cash for living expenses or that type of thing, or kind of deals that come up that they want to invest in.
Yeah, there's an interview with the founder of Tiger 21 actually on CNBC last week where he was talking about the public equity exposure. And I thought it was interesting that he said people in this group and the members of Tiger 21 actually use index funds for their public equity exposure. And that's because of all the data that we've shared before and will continue sharing because I still feel like it's underrated and kind of underknown or lesser known than it should be.
Underrated,
But
yes.
yeah, but just how indexing tends to outperform the vast majority of stock pickers over time. And I thought it was pretty telling and encouraging that the ultra high net worth people know that and are acting upon that with index funds driving their public equity exposure. And then the other thing that struck me from a recent podcast interview that Michael Sonnenfeld did, who's the founder of Tiger 21, was the same way we think about how much cash and bonds should be held is relative to the number of years of spending. So thinking about it as, okay, what's my annual spending times 3, 4, 5, however many years you want to hold in reserves, and that drives the equity, or sorry, that drives the allocation to cash and fixed income. So they despite having a lot higher net worth than most people out there, they think about the reserves for cash and bonds in the same way that we do as well. I thought that was pretty cool.
Yep. Even ultra high net worth people still keep an emergency fund.
Yeah, exactly. Exactly.
I guess the next thing that we wanted to touch on, Matt, was liquidity and cost. And those are two big things. And so kind of touching on cost for a little bit. These things are not cheap, to
No,
say the least.
no, they're not. That's absolutely right. And as I like to think about these and any investment opportunity for that matter, but the fees and the costs that you're paying are a certainty with the hope of buying something like this that the performance relative to any sort of passive or public benchmark ends up justifying that cost so that you end up ahead net of the higher expenses. But the performance is a hopeful or is kind of a potential thing that might happen in the future versus the fees that you're paying for the higher cost are a certainty. And the data just does not show typically that that ends up being a winning trade for most investors.
How much do these things cost that you've seen, Matt?
Oh man. Honestly, I
Like
actually just saw I just saw a
in
chart that
percentage
showed
terms, or
yeah, I just saw a chart over the weekend that showed the percentage management fee for private equity funds has been coming down over time, but it's still 1.5%. And so if you compare that to the index funds that most people use and that we tend to use as well here at Birchwood, those are, 3 to 5, maybe 10 basis points. And so you're talking about 10, 20 times the the expenses to buy into some of these private funds. And that's just the management fee portion, excuse me, because then you also have incentive fees of various kinds where the management fee gets charged by the fund manager just as a cost of doing business for managing the money. And then any profits that come in above certain hurdle rates tend to drive additional incentive fees towards the fund manager as well, which are coming out of the investor's pocket. And so blending those two things together, I think you can definitely get from 2% management fee up towards 3, 4, 5% as far as an all-in fee that you're paying relative to the assets you're investing in the fund, which is obviously incredibly expensive.
Yes. And then the other factor is liquidity, which what all that really means is that how quickly can your money be turned into cash? So if something is less liquid, that just means it's locked up somewhere or in a fund that you don't have access to, or there's kind of gates as when you can access that money, and usually it's months or sometimes even years. So you can only access a certain percentage every quarter, or my goodness, you can be locked up for a decade or longer in some funds.
Yeah, there was a great chart in the SVB, Silicon Valley Bank State of the Market slide deck from last year, and I view them as kind of the best experts out there on the venture capital startup ecosystem because they've been doing it for a really long time and have good relationships with all of the people that are biggest and best and most involved in that whole ecosystem. And they had a chart that showed in last year's slide deck the top performing venture capital funds don't return investor capital for 16 to 20 years, which just blew me away because it's one thing to say, hey, I know I'm going into something illiquid, I'm going into this eyes wide open, I don't need this cash. But I mean, thinking about how much can happen over a 15 to 20-year period is pretty incredible. If you think about having little to no access to your funds that you invest in something like this for that long is obviously one end of the spectrum versus things that we like to buy, which are in the public markets that you can trade on any given day that the market is open. I mean,
Yep.
I struggle to wrap my head around having something locked up for 20 years. That's incredible.
Yeah. I think in here we'll touch on in a second of that there are good reasons for locking your money up for that amount of time if the manager is good and that sort of thing. But just on a base case scenario, I think the majority of people that we work with and speak with, they really don't understand what that means, that their money is literally locked away for a long period of time. And I know anecdotally from my experience, I used to work at a large wealth management firm in La Jolla down here in San Diego. And the advisors, they kind of stuck their clients, they pitched them on this alternative investment fund. That was a multi-manager strategy. And clients go, great, great, great. They sign up for it, sign up all it took a ton of paperwork. Let me tell you, if you want to sign up for an alternative fund, it's a ton of paperwork. You're now an LP, and then you get a K1 and all this stuff. But what they didn't necessarily realize was that number one, the fund didn't perform very well. And then number two, when they actually wanted to take money out, or if we wanted to even do a rebalance, just a simple rebalance, we couldn't do it because they only had quarterly liquidity. And then it got to a point where the majority of folks were saying, just get me out of this. And we had to keep coming back to them and saying, you know what, sorry, you can only take it out quarterly. And then there's a 15% holdback. You won't get that back till another 18 months. It was just kind of a mess. So I just share that of my experience in an alternative fund with clients, and this was a big firm with a lot of capital behind it. So it didn't really work out the way that most folks thought it would. And then the last thing I touched on it a second ago, but just the dispersion of returns. So he said, hey, if you want to lock your money up away with a great manager, then that's obviously okay. But what do we see, Matt? What do we see about these managers?
Yeah, one of the problems with alternative assets in general is there is no way to buy the benchmark. And so what that means is you're picking individual managers to do to implement the strategy that you're paying them for. And what we've seen historically is the range of outcomes between the best and the worst is very, very wide. And so even somebody in the same asset class, like you can see on this chart, even somebody in the same asset class can get a very different outcome based on either the quality of the manager or the, idiosyncratic things that happen with that given fund. But unfortunately, you can't buy that orange dot in the middle. You either end up at the top or at the bottom of those bars. And obviously, we hope for anyone doing these types of investments that they would end up towards the top. But since we can't own the benchmark like you can with public securities, it just seems like a questionable idea to hope for being towards the top end of the bar chart, especially because based on the digging that I've done and the conversations I've had, there are good managers who can have good funds and they'll say, okay, our first fund did well, our second fund did well. And so even the same manager can have you get into the third or fourth fund, but all of a sudden, whatever happens, rates go up or the sector's out of favor. And even a good manager with a good track record puts you into the latest fund, and that fund doesn't do well. And so, all that to say, there's a lot more nuance and complexity and risk involved with picking managers and even picking funds of that manager that make outperforming the public benchmarks seem less and less likely
Yeah.
over time.
Just the range of what you actually get once when you put your money in is just so much wider than what you would ever get in a simple ETF or a mutual fund or something like that. And sometimes we kind of like to dunk on expensive mutual funds and that sort of thing. But from a perspective of do they earn pretty close to what they're trying to earn, it's actually much better than what we see in the private markets.
Yeah, absolutely.
Performance is a big deal, Matt, right?
Performance is a very big deal. Very, very big deal. It's hard to overstate the importance of investment performance when it comes to managing people's money.
Yeah. And the performance range is kind of anybody's guess. And you do sometimes really well if you're with a great manager, or you do really badly if you're with a poor manager. So I guess what do these things earn? I mean, you're talking about venture capital or private real estate and that sort of thing.
Yeah, I think the important question when you're looking at any investment opportunity is what is the potential return relative to what can be earned elsewhere? And so for each of the asset classes we mentioned from that Tiger 21 allocation, the question comes back to, okay, well, how does this compare to what I can earn elsewhere? So for example, thinking about private real estate and how it performs relative to something like publicly traded real estate investment trusts or REIT stocks, which are very liquid and have traded for decades now. What we've seen over time, based on data from a consultant firm called Cambridge Associates, who puts out benchmarks that are widely respected across the investment management industry, the benchmark of private real estate holdings in performance relative to REITs is a big difference, not in favor of the private real estate. What we've seen is REITs tend to do 8, 9, 10% per year, and private real estate tends to be in the 6 to 7% range. And so if you compound that over 20, 25 years or longer, you're going to really be sad if the buildings you owned or the property type you were concentrated in did less good than the REIT index, because the nice thing about REITs is they're very diversified, and so you own apartments, offices, hotels, self-storage units, data centers, whatever you want. That's in the diversified REIT index, and so once again, diversification wins over time, and we think that applies to private versus public real estate holdings too.
Yeah. And daily liquidity you can get out of a REIT pretty much same day or next day versus if your money's like if you own a house, how hard is it? You can't sell your house just overnight unless you sell it for pennies on the dollar.
Yeah,
So
and the compounding effect, like I said, of that, the Cambridge Associates data, 10% for REITs versus 7% for private real estate. I mean, over very long time horizons, that is a big difference in net performance and kind of net wealth accumulation. And you factor in, like you said, the lower liquidity you have from the private funds, the extra tax paperwork you have to do for K1s and things like that. That's a tough sell thinking about in general private versus public real estate.
and then you checked out a Larry Swendrow book that you thought had some kind of interesting
Oh
tidbit.
man, he had a great quote from Paul Tudor Jones, who's one of the best macro hedge fund traders around, and he's been doing it for a very long time and has worked with some of the best, like George Soros and guys like that. And Paul Tudor Jones had a very funny anecdote. It's funny in hindsight. I'm sure it wasn't funny for him at the time, of how leading up to the Lehman bankruptcy in 2008, he had grown the allocation of his fund towards these loans to companies in emerging markets, so lending to banks in Kazakhstan and all kinds of esoteric things like that. And it was justified at the time by, oh, this is a currency bet, there's diversification here, these are uncorrelated returns. And then Lehman failed, and the liquidity in those types of assets dried up immediately overnight. And Paul
Mm-hmm.
Tudor Jones reflected on that in a book called More Money Than God, which is a great book on the hedge fund industry. And his quote in the book was like, here I am priding myself as a guy who trades in stuff that's super liquid, like currencies and futures, and I can pivot whenever I want and I change my view. And all of a sudden, Lehman fails, and 40% of my portfolio has no liquidity at all.
Mm-hmm.
And I thought that was a great reminder of how liquidity matters most when you really need it. And so, in general, obviously, it's better to have more liquidity than less. And that applies to our view on public versus private real estate for sure.
So, not saying that we will are writing off private investments or alternative funds forever. We always try to find things that we think are compelling and worth our time and effort and clients' money and that sort of thing. But honestly, we just can't find stuff. So
Yeah, yeah.
um,
I've been looking hard and leaving no stone unturned, and I know you have as well, Stephen. And if I found a great idea and something that consistently outperformed the public alternative net of fees and expenses over time and was equally tax efficient, I would say, please let me in. I want to put my own money in and the money of all of our clients as well. But the same applies to what we were just talking about with real estate, using the Cambridge data for private equity, where if you adjust for leverage, the public markets have done much better over time. Venture capital, the same thing. You've been much better off just buying public tech stocks than buying VC funds, which are buying early stage and even later stage startups. Based on all the data we can see, the public markets tend to win based on performance if you adjust for things like leverage, and they're
mhm.
much more liquid. So yeah, I'm still hoping to find the hidden gem out there, which is uniquely attractive with long-term performance that's just as liquid, but so far no luck.
Yep, simplicity over complexity. Boring is beautiful. That's what we found to work, and we're gonna try to stick with it as much as we can. So, kind of as we wrap up here, yeah, there's not really any secrets per se of the wealthy. There's definitely more options available for you, but that doesn't mean that there's necessarily better solutions. And what's your favorite saying, Matt?
Yeah, I think when it comes to this topic and investing in general, the idea is just because you can doesn't mean that you should. And anybody trying to sell you a private or exclusive investment opportunity should definitely set off alarm bells and raise the red flag, because the public markets work really well and have a lot of good options with a lot of history we can look back at and a lot of liquidity and very low fees. So the bar for beating the public options is very high and should be for anybody who's evaluating any private asset out there.
Be skeptical of investment products and be sure that you're benchmarking to cheaper, more available solutions out there, like index funds or something like that. All right, you guys, be sure to like and subscribe. Thank you to Kevin, our producer and editor, and we'll see you next time.